Are you feeling the weight of your loans, wondering how to save more and pay less? Welcome to the world of financial wellness, where we unravel the secrets of managing money. Today's topic is about how you can lighten the load of your loans and potentially save a significant amount, all by tapping into the power of mutual funds. Mutual funds, in a nutshell, are a pool of funds collected from many investors that are managed by a professional fund manager. They're a powerful financial tool that can help you diversify your investments across various assets such as stocks, bonds, and other securities. A key advantage of mutual funds is that they offer the potential for higher returns compared to traditional savings methods. Furthermore, they can be a source of regular income, which can be used to pay off loans. But how do mutual funds connect to loans, you might ask? Well, it's simple. By investing in mutual funds, you can generate returns that can be used to repay your loans. This way, you're not just relying on your income to pay off your debt. Instead, you're using your investments to help you out. This method is particularly beneficial for those who have high-interest loans. By investing in mutual funds, you have a chance of earning a return that's higher than the interest rate on your loan. Hence, you could potentially pay off your loan faster and save on the interest that would have otherwise accrued over time. Now, it's important to remember that investing in mutual funds involves risks. The returns are not guaranteed, and you could potentially lose your initial investment. But with careful planning, thorough research, and a bit of patience, investing in mutual funds can be a strategic way to manage and pay off your loans. So, are you ready to explore how mutual funds can help you save on loans? Are you prepared to take the reins of your financial future and steer it towards stability and growth? If yes, then you're in the right place. Stay tuned as we delve into the process of saving on loans with mutual funds. Mutual funds, a term often tossed around in financial circles. But what does it really mean? Simply put, a mutual fund is a pool of money from multiple investors that is managed by professionals. These professionals invest in a diverse range of assets, such as stocks, bonds, and other securities, aiming to generate high returns. Think of it as a potluck dinner, where each participant or investor brings a dish, or in this case, a sum of money. This collective pool of money is then managed by a professional chef, the fund manager, who uses their expertise to prepare a lavish feast, or in financial terms, to invest in a variety of financial instruments. The goal? To serve up a profitable return on the original investment. Now, you might be wondering, why opt for mutual funds? Well, one of the key advantages of mutual funds is diversification. Diversification, in investment terms, is a risk management strategy that mixes a wide variety of investments within a portfolio. By spreading investments across various financial instruments, mutual funds help mitigate risk. This means that even if one investment doesn't perform well, others in the portfolio may still offer positive returns. Another significant benefit of mutual funds is professional management. For many of us, navigating the financial market can be a daunting task. Mutual funds take that burden off your shoulders. The fund managers, with their extensive knowledge and experience, make informed decisions on your behalf, aiming to maximize returns and minimize risks. Moreover, mutual funds offer liquidity. This means that investors can buy or sell their mutual fund units at any time, based on the fund's current net asset value. This flexibility makes mutual funds an attractive investment option for many. Finally, mutual funds can start with a relatively small investment amount, making them accessible to a wide range of investors. Whether you're a seasoned investor or a newcomer to the world of finance, mutual funds can be a valuable part of your investment strategy. Now that we have a basic understanding of mutual funds, let's discuss how they can help you save on loans. Loans can be a burden, but mutual funds can lighten the load. How, you ask? Well, let's dive into it. Mutual funds and loans might seem like two separate entities, but they intersect in a rather interesting way. You see, mutual funds are investment vehicles that pool money from various investors to purchase a diversified portfolio of stocks, bonds, or other securities. These funds are managed by professional fund managers who aim to generate high returns for the investors. On the other hand, loans, as we know, are borrowed money that must be paid back with interest. These could be home loans, student loans, or any other kind of debt that might be weighing you down. Now, here's where the two meet. The returns generated from your investments in mutual funds can be used to pay off your loans. Yes, you heard it right. The money that your mutual fund investments make could help lighten your loan burden. Think of it as a cycle. You invest in a mutual fund, the fund generates returns over the years, and these returns are then used to pay off your loans. It's like having your cake and eating it too, but there's a catch. Mutual funds, like all investments, come with a level of risk. The returns are not guaranteed and depend on the performance of the market. Therefore, it's essential to do your research, understand your risk tolerance, and choose your funds wisely. Another point to remember is that mutual funds are a long-term game. They are not a get-rich-quick scheme. The longer you stay invested, the higher the potential for returns. So while mutual funds can help pay off loans, they should not be viewed as an immediate solution to heavy debts. In essence, mutual funds can be a powerful tool in your financial arsenal. They can not only help you grow your wealth, but also assist in managing your loan repayments. We've seen the benefits, but how does one get started with mutual funds? Starting your journey with mutual funds need not be daunting. Think of it as a journey, not a sprint. It's about steady steps, not giant leaps. The first step is to understand your financial goals. What are you saving for? A new car, a house, or perhaps your retirement? Once you've identified your goal, you can determine how much risk you're willing to take to reach it. The next step is to do your research. There are thousands of mutual funds available, each with its own set of risks and rewards. To narrow down your options, consider your risk tolerance and investment horizon. You might also want to think about the type of mutual fund, be it equity, debt, or hybrid, that aligns best with your goals. After you've done your homework, the next step is to choose the right fund. Don't be swayed by short-term performance. Instead, look for funds with a consistent track record over the long term. Keep an eye out for the fund manager's experience and the size of the fund as well. Once you've chosen a fund, it's time to invest. You can do this through a lump sum investment or a systematic investment plan, also known as an SIP. An SIP allows you to invest a fixed amount regularly, smoothing out the highs and lows of the market. Now here's where the rubber meets the road. Once you've invested, stick to your plan. It can be tempting to jump ship when the market dips or chase after the latest hot fund. But remember, investing is a long-term game. Regularly review your portfolio, but avoid knee-jerk reactions to market fluctuations. Finally, be patient. Growing your wealth through mutual funds takes time. It's like planting a seed and waiting for it to grow. Over time, the power of compounding will work its magic, and your investments will grow. You're all set to start your mutual funds journey. But remember, patience is key. Like any journey, there will be ups and downs. But stay the course, and the rewards can be significant. Rome wasn't built in a day, and neither is financial freedom. Let's talk about two of the most valuable tools in your financial toolbox: patience and persistence. When it comes to investing in mutual funds, these two virtues are not just desirable, they are essential. Think about it. You're not just putting your money into a magical box and expecting it to multiply overnight. You're investing in a diversified portfolio of stocks or bonds, or a mix of both. These investments need time to grow, to ride the waves of the market highs and lows, and ultimately to deliver returns. This is where the concept of compound interest comes into play. It's the engine that powers your investments. The principle is simple. The interest you earn on your initial investment gets reinvested, and then that interest earns more interest. Over time, this compounding effect can lead to exponential growth. But here's the catch. Compound interest is a slow burn. It takes time. And that's where patience comes into the picture. You can't rush it, you can't force it. You have to give it the space and the time it needs to do its magic. That's why it's so important to start investing as early as possible. The longer your money is invested, the more time it has to compound and grow. Now let's talk about persistence. Investing in mutual funds is not a one-and-done deal. It's a commitment. Regular investments, whether monthly, quarterly, or annually, can help you build a substantial corpus over time. Even small, consistent contributions can add up to significant savings, thanks to the power of compound interest. So, patience and persistence. These are your allies in your journey towards financial freedom. They are the keys that can help you unlock the potential of mutual funds to save on your loans. Remember, the journey to financial freedom is not a sprint, it's a marathon. It requires discipline, commitment, and a clear understanding of your financial goals. And most importantly, It requires the courage to stay the course, even when the going gets tough. So, are you ready to save on your loans using mutual funds?